22% house price growth. Let's have a look. Hello everyone, Florian.heise here and welcome to another episode of HeiseSays. Grab your stein of coffee because, well, Westpac are predicting 22% house price growth. Remember, we've had our first recession in 38 years. International tourism is pretty much non-existent. Migration is non-existent. International students are non-existent. Markets are getting hit left, right, and center due to the relations with China. And, well, inflation is manifesting in construction. Food prices are going up. The government has had to use JobKeeper and stimulate the economy to keep everything going. And house prices are predicted to go up 22%. Now, well, I guess we can see part of the perhaps intended or unintended costs of government intervention. Will there be calls for a China-style property tax here in Australia to try and take the heat out of the market? But then, of course, all those councils want to keep that revenue flooding in. So house prices to rise 22% this year and grow further next year. Honestly, I think even if we did see a property correction in Sydney or Melbourne where it were to cool a little bit, and if we just jump here, we can see that, I mean, this is from SQM. I'll just reload this. Looking at the asking property prices for capital cities average, you can see that they're going up. Now, if we see as well, Sydney is going up. I'll just reload this. There you go. See it climbing. Good old Melbourne going up as well. And my town, Brisbane, it's gone up quite sharply. If anything, I suspect we're going to see maybe eventually even a slower growth in Sydney and Melbourne, but Brisbane's going to keep rocketing up. Westpac has tipped property prices to rise by more than 20% this year, increasing its price forecast yet again as the market continues to boom despite extended lockdowns. The bank expects property prices to climb 22% this year, up from a forecast of 18%, and has also lifted its outlook for the next year from 5 to 8%. How's the average person? It's not going to be possible to keep up. Housing in Australia isn't for the average person anymore. Everyone? It's not for the average. Those times are gone. However, it has warned that the property boom is entering trickier territory with a correction expected from 2023. Senior economist Matthew Hassan said the property market, fueled by record low interest rates, have blasted past price expectations, going well above earlier forecasts for 15% growth this year, with only a slight dampening from the latest COVID lockdowns. Prices rose across the country, another 1.5% in September, taking the nation's median dwelling price to almost $675,000, according to the latest CoreLogic figures. Values are up 17.6% since January and more than 20% over the past year, making the fastest annual growth since 1989. Mr. Hassan expects prices in Sydney to jump 27% before the end of the year, with values in Brisbane and Hobart also expected to climb more than 20%. Annual price growth of 18% is forecast for Adelaide and Melbourne, and 15% growth is tipped for Perth. ANZ also expects national growth to be more than 20%, revising its forecast upward in recent months, while CBA increased its forecast to 20% and NAB increased its forecast to 18.5%. Westpac's increased forecast comes after APRA announced banks had to lift the buffer rate applied to loan serviceability assessments from 2.5% to 3%, which is estimated to reduce maximum loan sizes by about 5%. And here's the thing. If people are worried about the cash rate climbing up and then that impacting the markets and all these people being forced to sell, they've got buffers, everyone. There's expectations. You have people in property. You've got housing liquidity. People have got months of money set aside. You've got people making prepayments on their mortgages as well. They're ahead. And I'm sure a lot of the viewers here, guaranteed, a lot of the viewers of the channel are ahead significantly on their mortgages. Or if not, you've got it set in an offset account. Some people probably even have a 100% offset account. The move came earlier than expected, Mr. Hassan said, though he felt its impact on the market would be marginal, given more than 80% of borrowers were not taking out the maximum loan size available. There you go. Yeah, I don't think it'll make any difference. However, further tightening of lending restrictions, such as a crackdown on high debt-to-income ratios, may have a bit more of an impact, particularly on investors with multiple properties. Still, he expected investor activity to lift from its comparatively subdued levels, accounting for just 25% of the value of loans over the last 12 months, compared to close to 40% over loans over 15 and 17, as affordability constraints squeeze out owner-occupiers. Now, here's a chart I want to show everyone that I've been showing more and more. This is, well, the differences in income for households. You've got the higher income over $2,000 a week. You've got middle, just under 1,000, about 933, and you've got the adjusted lowest at 430. Adjusted lowest, you're going to struggle to ever get into a house. Even middle, you're going to struggle. Even high, in some areas, you're going to struggle to get into a house. Australia isn't an egalitarian society, guys. That's long gone. So, and if anything, this COVID restrictions, lockdowns, and certain industries getting hit has exacerbated the divide. That is a real risk factor for the market. Investor segment has been pretty subdued throughout the boom so far. But if there's a segment that's going to sustain the boom for longer, it's likely to be investors, he said, which could drive more persistent price gains near term, but also result in a more material correction. This is the pointy end of the price cycle, where affordability strains start to price people out of the market altogether. Even if you do have investors coming in a big way, that's a riskier environment in terms of sustainability and price gains and the tolerance of regulator. We are getting into much trickier territory, and the policy side of things is now in play. Already the Sydney and Melbourne markets are 18% and 10% respectively above the previous peak in 17-18. Wow. A time when both had major affordability problems. Mr. Hassan expects the market to have run out of steam by 2023, forecasting a pullback of 5% as official interest rates rise, though the Reserve Bank has still forecast its first cash rate hike pegged for 2024. But are you forgetting the calls for 2 million new migrants into Australia over the next 5 years? I wonder what that will do for the demand of housing or investment properties, everyone. I just wonder. Even though rates will still be low, it's about the shift in the direction and the sentiment. There's no more scope for rapid price growth. And I think that will be the thing that tips us over into correction, he said. Dwelling completions at a time of low population growth could also weigh on prices, he added, with more than 200,000 dwellings completed this year, more than double the increase required with slower population growth. Oversupply has so far been limited to certain pockets given the prolonged period of underbuilding that preceded the latest building cycle, but that may shift in return to significant net migration inflows, takes several years to come through. Well, let's have a talk about this one, everyone. What I think we're seeing here is predictions of, property price growth. But remember, as a Brisbaneite, we've got the Olympics, and then we've got calls for more migration. I think, from my perspective, in my city, our prices will probably start to creep up to a level closer to Sydney and Melbourne. Awesome. That's really going to do wonders for affordability. Even if we see a correction, or even if we see flat line for the next few years, that's still going to be an affordability issue. We have a systematic obsession with housing here in Australia, and I don't blame people. I do not blame people at all for getting into housing. Why wouldn't you? When you don't have to deal with staff, you don't have to deal with the bullshit of starting a business, you don't have to deal with mandates. Just get into property. What do you reckon, everyone? Do you expect to see property go up? Do you expect to see a 22% price rise? I would not be surprised in the slightest. And remember, this is the sector that our government uses to stimulate the economy. As always, thanks for watching. Like, share, subscribe to the channel. If you're a fan and enjoy the content I find and present here, there's a few ways you can help out. You can sign up for our live channels on YouTube or Twitch. You can also support us financially by joining us on YouTube or Patreon. Sign up for Stake or SelfWealth, and you can help us with our share trading. Use our affiliate links at Amazon, eBay, Independent Reserve, or AussieBroadband. Buy our merch from HeiseSays. Use Gold Pass from the Perth Mint, or support us via PayPal. Take care, and I'll see you all next time. Bye for now.